So you want to buy a shopping mall. Hundreds of stores, all paying you rent, hundreds of thousands of shoppers walking past your storefronts every single month. Here's the part nobody tells you. The mall isn't really in the retail business. It's in the foot traffic business. And the moment the foot traffic stops, the entire financial structure underneath it can collapse in years, not decades. That's not a contradiction. That's the whole business. And once you understand why, you'll never walk through a mall the same way again. Let's start with what you're actually buying, because it's rarely just a building. Most large shopping malls today are owned by real estate investment trusts, REITs, publicly traded companies that pool together dozens or sometimes hundreds of properties into a single portfolio. This structure exists for a specific legal reason. A REIT is required to distribute the vast majority of its taxable income to shareholders every year, and in exchange, it avoids paying corporate income tax on that money. For an ordinary investor, this means you can own a small slice of a shopping mall empire through the stock market for the price of a single share without ever personally dealing with a leaking roof or a bankrupt anchor tenant. For a private buyer looking to purchase one mall outright, the picture is very different. You are putting all of your risk into one building in one town, subject to the fortunes of that specific local economy. The price tag itself tells you almost everything about what kind of bet you're making. A top-tier mall, the kind with a luxury anchor, high sales per square foot, and a waiting list of brands trying to get in, can sell for well over $1 billion because the income is stable and predictable for decades. A mid-tier or declining mall in a weaker market can sell for a tiny fraction of what it originally cost to build. Some regional malls built for tens of millions of dollars in the 1970s and 80s have changed hands decades later for less than the price of a handful of suburban houses. The lesson is the same one that applies to almost every asset in this category. You are not really buying a building, you are buying a bet on a neighborhood, and the price tag tells you which bet you're actually making. Say you've settled on a mall and the number seems reasonable. Before you collect a single rent check, there's a layer of inherited obligations that catches almost every new owner off guard. The anchor leases you inherit are usually decades old, signed on terms you had no say in, and often locked in for years before you get any chance to renegotiate. Then there's deferred maintenance. Roofs, HVAC systems cooling and heating over 1 million square feet, parking lots, escalators, elevators, all wearing down continuously. And if the previous owner was cutting corners to make the books look good, you find out about it the first time something major breaks. And buried in nearly every mall lease is something called a co-tenancy clause, a contract term that allows smaller tenants to pay reduced rent or walk away from their lease entirely if a major anchor store closes. You don't feel this cost on the day you buy the mall. You feel it the day one anchor leaves, and suddenly a dozen other tenants are legally entitled to pay you less, or nothing at all. Now, how does a mall actually make money once it's running? Because the structure is more layered than most people realize. The first and simplest layer is base rent, a fixed monthly amount every store pays, typically priced per square foot per year. Specialty retailers in a strong mall might pay somewhere in the range of $40 to $70 per square foot annually. Anchor department stores, by contrast, often pay a small fraction of that, sometimes as little as $2 to $5 per square foot, because the anchor isn't really paying for space. It's paying for its name and its ability to pull customers past dozens of smaller stores on the way in and out. Every other tenant in the building is, in effect, subsidizing that discount, because they're the ones paying full price to be near it. The second layer is percentage rent, money on top of base rent, tied directly to how much a store actually sells. A typical structure works like this. A store agrees to pay its base rent, but once its yearly sales cross an agreed threshold, called the breakpoint, the mall takes a percentage, often somewhere between 5% and 10% of everything sold above that line. This is money that scales automatically with how well the mall performs, without the owner lifting a finger. The third layer is common area maintenance, CAM for short, separate from rent entirely. This is tenants paying their proportional share of what it costs to run the shared parts of the building: cleaning, lighting, security, parking lot upkeep, based on how much space each tenant occupies relative to the whole property. This matters enormously later in the story, because it means a large share of what it costs to physically run the building isn't paid by the owner directly. It's billed straight back to the tenants who are still there. The fourth layer is everything that isn't a store at all. Parking fees in dense urban locations, advertising space on digital screens, kiosks in high-traffic walkways that can charge extraordinary rent per square foot precisely because they occupy almost no space while sitting exactly where foot traffic is heaviest. Pop-up events, seasonal markets, photo opportunities. None of this fits most people's mental picture of owning a mall, but for the right property, it adds up to a meaningful share of total income. All four layers sound like a machine that prints money from every direction at once. Now here's the other side of the ledger. Utilities on a building this size are enormous, keeping over 1 million square feet climate-controlled year-round, lit, and running. Add security staffing, ongoing cleaning contracts, landscaping, snow removal, and a constant stream of small repairs, and the operating bill for a large mall can run into the hundreds of thousands of dollars a month before a single dollar goes toward debt service. Property taxes on a large commercial property in a major metro area can be one of the single largest line items of the year, and insurance costs have climbed sharply across commercial real estate in recent years, particularly for older buildings. Here's the detail that catches almost every new owner off guard. Those shared CAM costs don't shrink just because part of the mall sits empty. The hallways still need cleaning whether every store beside them is occupied or not. The lights above a vacant storefront still need power. Security still has to patrol the entire building, not just the leased sections. So when vacancy rises, the same fixed pool of shared expenses gets divided among fewer paying tenants, meaning each remaining tenant's bill quietly goes up, even though nothing about the building's actual upkeep has changed. Rising vacancy doesn't just mean lost rent from empty stores. It raises the cost of staying in business for every store still open, which pushes marginal tenants toward the exit too. And here's the trap almost nobody sees coming until they own the place. A mall can look almost fully occupied and still be losing money because occupancy and income are not the same thing. If a large share of that occupied space is anchor stores paying next to nothing, and a growing share of the smaller stores are on short-term, discounted leases just to keep the lights on, the actual cash flow can be far weaker than the headline occupancy number suggests. To understand how this plays out in the real world, look at a mall that had every advantage on paper and still didn't survive. In the 1970s, a large enclosed shopping mall opened in the middle of what would become Silicon Valley, one of the wealthiest, most economically dynamic regions on the planet. For decades, it thrived as a major regional retail destination. Then, starting in the early 2000s, its anchor stores began leaving one by one. A newer, more modern retail development opened nearby and pulled shoppers away. By the mid-2000s, nearly all of its tenants had left, and the building sat largely empty in the middle of some of the most expensive real estate in the country. Demolition began in the fall of 2018. This wasn't a mall in a declining town with a shrinking population. It was surrounded by some of the highest-earning households in America. The mall didn't fail because the neighborhood ran out of money. It failed because the retail format itself stopped matching what that neighborhood wanted. And once the anchors left, the co-tenancy clauses did the rest, triggering rent reductions and lease exits across the property until there was nothing left to sustain the building's enormous fixed costs. Now compare that to a mall that on paper looked like an even bigger gamble. In 1992, a mall opened in Bloomington, Minnesota, built on the former site of a demolished baseball stadium, designed to be the largest enclosed shopping and entertainment complex in the country. Critics were skeptical that a market the size of Minnesota could ever support a mall that large. In its first full year, it drew more than 40 million visitors, more people than visited the Grand Canyon, Disney World, and Graceland combined in a single year. By its fifth year, its stores generated over $700 million in annual sales. The mall's own economic impact was estimated in the billions of dollars annually for the surrounding region. Here's the detail that actually explains the difference between these two outcomes, and it isn't the size of the check that got written. When this mall first opened, anchor department stores made up only about a third of its total square footage, an unusually low share for a mall of that era, while specialty stores made up the rest, giving it more than 3 times as many individual retailers as a typical mall of similar size. Layered on top of that was an indoor theme park at the center of the building, an aquarium, movie theaters, and later entertainment venues that had nothing to do with traditional retail at all. The mall wasn't betting its entire financial structure on a handful of anchor department stores staying profitable forever. It was betting on being a destination people would travel to see, whether or not they bought a single item of clothing while they were there. That's the structural lesson underneath both stories. The Silicon Valley Mall depended almost entirely on the traditional anchor and specialty store formula, the exact formula that department stores across the country began abandoning through the 2000s and 2010s. The Minnesota Mall built its foundation on something department stores can't replicate online or anywhere else, an actual physical experience worth traveling for. When one mall's core product stopped being unique, it collapsed. When the other mall's core product was something no website could ever deliver, it kept growing decades after critics said it couldn't work at all. Now, the structural risk that runs through this entire industry, and it isn't a bad economy, it's dependency concentration. For most of the 20th century, department stores were the backbone of the shopping mall, the reason banks would even finance construction in the first place, because lenders wanted the guarantee of foot traffic that a major anchor provided. But starting in the 2000s and accelerating sharply after 2010, department stores across the country began closing at a rapid pace, driven by shifting consumer habits and the rise of online shopping. Because of co-tenancy clauses, one anchor closing doesn't just remove one tenant's rent check. It can trigger a wave of rent reductions throughout the entire mall, sometimes affecting dozens of stores simultaneously, all because of contract language written years earlier, back when everyone assumed the anchor would stay forever. And filling that empty anchor space back up is neither simple nor fast. These buildings were constructed for one specific kind of tenant, enormous floor plates sometimes exceeding 100,000 square feet, with loading docks and layouts that don't easily convert into anything else. Subdividing a single old department store building into smaller modern retail spaces can cost tens of millions of dollars and take years. And that cost multiplies across every empty anchor box a struggling mall might have at once. This is the structural truth underneath the entire industry. A mall rarely fails because business is universally bad. It fails because one piece falls out, and the rest of the structure was quietly built to depend on that piece staying exactly where it was. Zoom out across the industry, and the pattern becomes obvious. The malls that thrive today are almost never the ones that simply built the biggest traditional retail floor plan. They're the ones that reduced their dependency on any single anchor, diversified into restaurants, entertainment, and services that a computer screen genuinely cannot replace, and treated the building as a destination rather than just a collection of storefronts. The malls that fail are almost always the ones that assume the traditional anchor-driven formula would keep working indefinitely. The same assumption that quietly doomed the Silicon Valley Mall despite sitting in one of the richest zip codes on Earth. So, does owning a shopping mall actually work as a business? The honest answer depends entirely on which mall, and the gap between the good outcome and the bad outcome is enormous. In the optimistic scenario, you own a well-located property with a diversified tenant mix, low dependency on any single anchor, and enough non-traditional draw, entertainment, dining, experiences that people keep showing up regardless of what's happening to department stores nationally. Base rent, percentage rent, and CAM reimbursements together produce steady, compounding income for decades. In the realistic bad scenario, a single major anchor closes, co-tenancy clauses trigger, CAM costs get redistributed across a shrinking pool of tenants who are themselves now paying more to keep the lights on in emptier hallways, and the building slides from fully occupied to worthless in less time than most owners think possible. Neither outcome has much to do with how nice the building looks on opening day. A mall looks from the outside like a building full of stores. From the inside, it's a single, tightly interconnected financial system where every tenant's fortune is quietly tied to every other tenant's fortune, whether any of them realize it or not. The building was never really the business. The reason people kept showing up always was.